Good morning, everyone. Welcome to today's webinar, Capturing Volatility with Option Flexibility. Today's presenters are CEO of Saliba Ventures and author Tony Saliba, and Michael Martin, a professional trader for 24 years, author of The Inner Voice of Trading. Welcome, Tony and Michael.
Good morning, Tom. Thank you.
Sure.
Good morning, everyone.
Okay.
Today we're going to cover, well, I'm sorry, Tom, go ahead.
Okay. Anyway, my name is Tom Hartle. I'm CQG's Director of Product Training. I'll be your host and moderator today. Before we get started, I want to mention a few housekeeping items. If you have any questions during the webinar, please enter them into the Q&A section window at any time. We'll have Tony answer the questions at the end of this presentation. If you're viewing the presentation in full screen mode, you can find Q&A in the WebEx toolbar at the top of your screen in the drop-down menu on the far right. If you're having any sound issues, please contact the host via WebEx chat. We'll be recording today's webinar and it will be posted within 48 hours to the events section on news.cqg.com. All registered attendees will receive an email with a link to the recording. Now it's my pleasure to introduce Tony and Michael. Tony's interest in trading began in high school, and after leaving college, he worked as a stockbroker in Indianapolis. In 1979, he moved to Chicago and became a clerk at the Chicago Board Options Exchange. At one point, he and a partner began training clerks on how to trade. By 1987, he had 27 traders working for him. At that time, he was also named director of the CBOE board, a post he held until 1990. He traded equity options as an independent market maker on the CBOE. Later, he traded currencies and the S&P 500 contracts on the CME, along with agricultural and interest rate products traded on the CBOT. He's the only options trader featured in Market Wizards by Jack Schwager. He's author of the upcoming book, Managing Expectations, Driving Profitable Option Trading Outcomes Through Knowledge, Discipline, and Risk Management. As I mentioned, Michael Martin is also going to be talking a bit. He's author of The Inner Voice of Trading. He coaches and mentors other traders online and in person along the lines of what he's learned over his career from his own teachers, especially at Sequoia, Victor Sperandio, and Michael Marcus. So, Tony, it's my pleasure now to turn the webinar over to you.
Thanks a lot, Tom. Sorry, everyone. Good morning again, and welcome. I've traded a lot of markets, including commodity markets way back in the day, and more recently been involved in the Chinese markets. And what I find as we encounter new traders, and some that have actually been trading options for a while, is that some of the more basic and simplistic strategies are not being recognized or used properly. And today, I'd like to cover a series of strategies that allow you to capture volatility and a price path of your expectations a lot easier with some flexibility. Let me see. Okay. A couple terms that you should be familiar with are the historical volatility and the implied volatility. The historical volatility is the actual volatility of the underlying, which is measured over a specific period of time. So this is the vol level that your options should trade at. But option prices are based on supply and demand, and they trade at a volatility that is measured, called implied volatility, and this is the vol that the market tells you where they're trading at. And this helps you understand whether or not you believe that the prices are currently overvalued or undervalued. Volatility is the actual definition, is the measure of how much the market expects the underlying to move within that option price. And this is, as I said, the market tells you this, so we backward engineer that using a model, typically a Black-Scholes model or a variation on that model, and it'll give you a vol work backwards with the price already filled in the equation. The 5 actual inputs are your strike price, your expiration, the current underlying price, the expectation, well, the current interest rates and possibly the expectation in the interest rates, and then any dividends if the component actually pays dividends. In the case of today's example, that won't be necessary. So we're going to look at October sugar for our example today. And we are going to work on a core idea that we're bullish on the underlying. And we're going to look at the October 18 calls. So I'm making an assumption that you own the calls, and we have 15 days till expiration. So the OC18 calls closed last night at 3:07, and as we move, I guess we only have 14 days now. As we move closer to expiration, the premium or the extrinsic value, that value that is not made up of the underlying price, is going to start to decay most rapidly. So we have some decisions to make. One of those decisions is to sell out your long position, go flat, and regroup, take a profit, and call it a day. Or what we like to look at is the up and out. So we're going to focus on the November 21 strike, which is trading at, let's see, it closed last night at 87, or during the day yesterday it was trading at 87. So we can restructure your long position by moving into a straight bull spread, a ratio spread, or a back spread, butterfly or condor. We're going to do the up and out first. So with the absence of an execution platform, you would leg out of this spread by selling your OC18 call at 255 and buy the out month October 21, which would give you extended time and also reduce your risk by selling a deeper call. But by using CQG's order entry, you're able to create a spread or a user-defined strategy. I think it's called the spreadsheet trader, and it would allow you to actually formulate that as a single strategy, a spread, closing out your long OC18 call and buying the NOV 21 call. So now you're effectively long, your net effect here is that you're long the NOV 21 call, and you have taken money off the table and you have a credit. So you move your strike up, but you also took a large amount of money off the table, and you extended your holding period from 14 to 46 days. We did these Monday, I guess, yesterday. So the equation, or the way to look at this is that the credit on the board is the difference between your 255 sale and the 87 purchase. Now, to complete your bull call spread, you would look up a strike to the NOV 22 calls, which are trading at 51 cents, and sell those. So now you have a 36-cent or $403 debit instead of your $974 that's was exposed, and reducing that risk by more than half, but you cap your upside at the 22 strike. This is based on your expectations of the underlying movement over the next 40-some days, moving into that price zone. So your risk exposure is the 36 cents. That is the net for your spread, and you have a 64-cent possible gain, which gives you a break even at 21.36. And the simple math is the lower strike price the upper strike price subtracted from the lower strike price premiums. Here's that math that shows you the call vertical gain and loss. So you have a 36-cent net debit, which is a differential between your two premiums. So it's the first strike price minus second strike price, and that's your max loss. And then your max gain is the difference between the two strikes, the 21 and 22 minus your 36, which is 64 cents or $716.80. Now, vertical spread can be confusing because while both strikes are out of the money, they both have extended volatility and decay properties. But as the underlying moves up and your lower strike becomes in the money, the vol levels drop, and the upper strike has more actual implied volatility in it. So you're looking at the spread, which is a fixed risk spread, and the vol that you're long is shorter or is less than the vol that you're short. So in that case, you can be long a call spread and actually be short volatility. One of the things I've always told my traders and the plan that I've lived by is to have a well-defined path to risk management, and that would be based on your expectations, whether they be founded in technical or fundamental analysis of the underlying, a deep study of volatility trends, or supply and demand in your underlying market. In the case of sugar going through a squeeze situation can distort some of the volatilities. There's a large divergence of your risk characteristics, which we call the Greeks, which are the output of the model, delta, gamma, vega, theta, and rho. And as you get closer to expiration, if your option position is the front month, they will become very sensitive to small movements in the underlying and supply and demand. What we do, and depending upon how active an options trader you are or will be, typically a risk management system, an options calculator at a minimum, or some full-blown systems that are on the market that are very good at doing this automatically for you. We do sensitivity analysis, and we'll shock the underlying up and down 1, 2 standard deviations, shock the vol 15%, typically either way, to a great degree more on the downside than on the upside, and move your date leaving your expiration the same, but moving the trade date out in time will show the effects of decay, the theta, coming into or leaving your position. This gives you a matrix of an understanding of how this position could react. And if you're just trading a very simple vertical spread, it doesn't take a lot to do that, and you're able to see, when there might be an optimal point in time and price to exit the position. So with sugar moving up, then the question is, will your implied volatility collapse or expand, and will the underlying move sharply or gradually? This is setting your expectations on what you believe the marketplace is going to yield, and then try to change or modify your position in a way to take most advantage of that expectation happening correctly. So if you believe the underlying will rise gradually or maybe even stay flat, volatility will typically, implied volatility will typically collapse, and in that case, your opportunity may be enhanced by taking a little extra risk and selling an additional upside call, and this would be called the ratio spread, and you'd be long the NOV 21s in this case, and short the November 22 calls. So you have a call spread, which is a short ratio. If the volatility, well, in this case, if the volatility collapses, premium will come out of two calls, the 22s, faster than your lower strike 21s, and profit will come into your position without necessarily price change. And in this case, you wouldn't have to hold it to expiration. There would be an opportunity to take the position off early. Conversely, if you expect the underlying to move away sharply in either direction, and thus an expansion of volatility, the reverse position would be recommended. Thus, having a upside extra call if the market was to move very sharply, or in the case of a down move and where volatility increased, you'd have two calls that would hold volatility and thus premium versus a lower strike, more expensive call that would lose the premium faster, and volatility impact would be lighter. What if you have a specific price target or range that you expect to occur within a certain time frame? For instance, let's say the 22 level is really where you think sugar is going to settle in during the November expiration. In this case, we would take your long 21 call, and whether you did the ratio spread and already are short two 22s, thus needing only to add the third leg, the NOV 23 calls, or actually put the entire position on as one spread, this would be the NOV 21, 22, 23 call butterfly. This allows you to create a profit profile at expiration that looks like this and has the most opportunity at the center strike should sugar expire at or near, very near to the 22 level. This is one of my favorite trading positions because you have actually 4 options to deal with. You can find various opportunities to adjust the position throughout the course of the cycle based on underlying movement or breathing of volatility, and it's a contained risk. So what we're looking at here in the case of yesterday's prices, we would own that NOV 21 call for 87 cents. We'd be short 2 of the 22 calls at 51 cents, and long the far out of the money 23 for 29 cents. Now this is the ratio call vertical with an added call, the 23 call for protection on the upside, and that's another way to look at this. But it's a call butterfly and very versatile. So in this case, we've had a net outlay or debit of $156.80 for one butterfly, a 1x2x1. We name it by the wings, and it would be long one call butterfly. So that's our maximum risk. Above 23, both the 21 and 22 calls, or let's say at 23, both the 21 and 22 calls are in the money. The 21 call would be worth 2. The 22 call would be worth 1. You have 2 of them, so that offsets, and the 23 would be worthless. Anything above 23, the 21 and 23 move in tandem, pari passu, with the 22 calls, so the net is 0 on the upside, and on the downside, all of these options go to 0, so you would lose your $156.80. That also happens to be 50% of the value of the butterfly. So if it landed right on the 22 strike, you would net $156.80. Now, typically, that's a lot to pay for a butterfly. It's only a 2-to-1 opportunity, 50-50. And during the course of trading, you might be able to leg into them much cheaper, particularly if you're long a vertical spread. In our very first example, the NOV 21-22 call spread upon a rally would allow you to sell the NOV 22-23 call vertical short and possibly put the butterfly on for a lot less than the $156. This is the math on how you calculate the dollars, the contract size multiplied by 87 cents. So your debit is 974 cents for the first leg, and you're taking in a credit of 51 cents twice, multiplied by the same contract size, and you pull in a credit of 1142. So that's your initial ratio spread. But then you protect it with the upside by buying the 22 call for 29 cents times your multiplier, which costs you $324, and the net is your $156.80. A variation on the butterfly is to skip a strike and create what we call a condor. Okay, and there's variations of condors, extended strike condors, elongated condors, but a classical definition of this spread is where the strikes are all contiguous. So in our case, you would have our familiar NOV 21 calls, the NOV 22 calls. So there's your call vertical, which we end up paying 36 for, and then become a seller of the NOV 23 calls instead of a buyer, and cap off the condor by buying the NOV 24 call at 16 cents, collecting 13 there. So your net is a 23-cent outlay, and your max gain is the difference between the middle two strikes should it land somewhere between 22 and 23, less whatever your outlay is, okay? And your max loss should sugar close below 21, at 21 or below, or at 24 and above, it's our premium paid. And then your break even is your premium paid plus the lower strike, or the higher strike minus the premium paid. Now, just as a butterfly can be entered as one singular spread and traded more risk-free as a package, same can be done as a condor, or it can be legged into. You still have 4 different choices of trades to make, and depending upon the size of trade, it's very, very difficult to do this with just one lot, but if you're trading multiple lots, 5, 10, or more, let's say, you can scale into the condor just as you can scale into the butterfly, and creating strict vertical spreads or ratio spreads while you wait for something to happen in the underlying or volatility to add to the condor. But the key is to get, like the butterfly, to get to the classical definition and classical construction of the condor, and then let it sit. And as the market moves to your expectations, the aspects of decay will work for you, and if it lands at or around your expected price, you have the greatest opportunity to profit from a position that is lands where you want it to. And this is the I'm sorry, I skipped. So in the case of this condor, we would have paid $257.60 for that condor. As I mentioned, it combines buying an in-the-money vertical, or slightly at-the-money vertical, and selling an out-of-the-money vertical. And you can do these with either puts or calls. Classically, the options are struck equidistant, but as you can find online or in our book, many places, there are many variations on the theme of a butterfly. There's the pterodactyl, and there's the pregnant butterfly, and these get to be a little more complex, but if you're trading in larger size, it allows you to scale in and scale out of strategies that actually are founded in very strict and classical payouts, and they're risk averse, and you can literally sleep at night if you have these on. Kind of made a career trading these, and got to know the characteristics of the spreads for my various underlyings that I traded, and it's a good set of tools to have in your trading toolkit. As I've mentioned in many times, and it was quoted by Jack Schwager in the Mark Wizard's book, something that I called an explosion position, and this basically was to take one of these sideways preferred strategies, butterfly or condor, and add out of the money, deep out of the money cheap puts or calls. In the case of upside explosion, perhaps using the D's 23 calls. In this case, buying a little extra time and a little bit further out of the money. So if you did get an extended move, you'd have protection and profitability there on the upside. The same can be done, though, on the downside, possibly using the 15 or 14 calls. In summary, puts and calls have interchangeable characteristics. Together, they make up a synthetic of the underlying, so they both can be bullish or bearish. Calls, bearish, obviously, selling them naturally bullish, buying them vice versa with puts. Using them with a paired strike, in the case of vertical, you can gain great flexibility. And I coined a phrase when I was hyperactive trading, and it's really done me well over more than 3 decades, and that is staying spread is staying alive. I think having an additional leg properly is always going to be better than just being outright naked, and it allows you to have strategies. Another thing we always said, I would rather be in a good spread at a bad price than just blowing out a bad trade for a loss too quickly. So it allows you to have longer trading sustainability, allows you to use the characteristics of options to a greater degree, relative pricing, which is the ability to calculate the absolute payouts and look at option prices compared to each other rather than have to count on models. If you're trading large, though, definitely analyzers are recommended. But it allows you to dictate how time and price work to your advantage based on your expectations. And of course, you always want the leverage to work, for you. So that's a quick overview of a very important spread to have in your toolkit. And our book will be out in October. We'll have these examples and many more in great detail with all the equations. I've recorded the audio book already. There's a lot of history involved in how to utilize spreads and look at volatility from a layman's point of view. So if you're not associated with a large institution that is using a combine effect of market making, it's a great way to utilize options to enhance your underlying trading or just to trade solely on their own. So if there's any questions on what we just talked about, I'd love to take those questions now.
Thank you, Tony. And can you hear me?
Yes. Thanks, Tom.
Okay. Well, so far I'm not seeing any questions come through, and I think that's because you did such a nice detailed presentation for all these different types of strategies and the what-if ways to use them. Anybody who's on this webinar that is using CQG and is not familiar with our what-if spread options, analytics, packages, and scenarios, please contact CQG product specialists. They'll be happy to walk you through that, as well as how to use our user-defined strategies for trading exchange-listed spreads.
Great, Tom.
We do have a question. Tony, one quick question here about how do you measure realized gamma?
How do you measure realized gamma? Well, so I'm assuming that you have a position on and you have a long gamma and a short gamma offset, and your realized would be the difference between the current gamma and the initial gamma or your gamma cost. And the thing about gamma is that a change in your implied vol is going to make a huge swing in your gamma. So you take, the way we would look at it is you would take your existing long gamma position and subtract that short gamma at the moment from an implied basis. I guess I would need to ask the question, is this something that is a academic approach to this, or would they be looking for a further offset of a giant position that had extended amount of gamma? Because basically in a calculator or an analyzer, your gamma is being calculated in a real-time basis, and unless you're closing out a position, I'm curious as to why that would be something that would be important for the trading position.
Okay.
Well, I see the question in terms of realized and implied volatility. So it's important about the historical and implied volatility. I don't think I use the term realized volatility, but the implied volatility is what is trading at the moment. It is your actual realized volatility, but it's fleeting, right? It's totally supply and demand. So that directly impacts the gamma calculations, and it's a simple addition subtraction calculation. But if you have a small position, it's not going to be that important. If you have a large position, your calculator or your risk management system will be calculating that for you. I see that there's are there other questions? Could you walk through an example of adjustments you might make in a butterfly? Absolutely. Okay, so in the case of, if we have a moment, Tom, to answer that one?
Sure.
Okay, great. So one of my favorite things was to get stuck in a position that I could turn into a butterfly. And if the reverse is looked at, where you have a butterfly position on, and we're sticking with sugar, and we're sticking with these these three strikes, these four positions, 21, 22, and 23. The movement of the underline is going to dictate how I'm going to leg one way or the other. So if I'm looking for a settling in at November expiration at the 22 strike, for instance, and it moves through 22 much more prematurely than I expected, and possibly is even approaching the 23 strike, my 21-22 call spread, I'm going to be watching that to sell it as close to a point as possible. Now you might say, well, now we're going to be short. But if you could close it out early for as close to the full value as possible, let's say you could get 95 for that with a week or two to go, or longer if you're that lucky, you can leave your 22, 23 vertical short, and now let's say you sell it for 95 cents, you've added 5 cents to your worst case scenario. But if the market retraces and falls below the center strike, now you're hoping that it just goes south because you're going to collect the full value of that 22, 23 vertical spread. So that's one instance of adjusting a butterfly if the market rallied, if sugar rallied too prematurely. If sugar retraces early on and you're still expecting a move to the upside to approach 22, you do the opposite and you take the 22-23 spread off when it gets very cheap. If they smash that 22 call, then to close that out. You might even just take it off naked if you can't get any value for your 23. Then with a retracement back to the upside, you're long the 21, 22 vertical at a slightly higher cost because whatever it costs you to take off the 22, and you have some choices. You could replace the 22, or you can just let the position run. And this it's like a pendulum. Some people call it swing trading in stocks, or even in commodities, where you have a center point that the underlying is rotating around. And this can be done with options in a butterfly position because you always have a defined amount of risk. And this is just something this is one of many adjustments that you can make. You can just take off one of your shorts on the downside and then have a ratio spread to the upside, or when the market's really blown through your upside strike, to sell out the vertical, as I said, or add a put vertical to the downside. So if it retraces back, and you're protected with that butterfly. So there's many examples in our book. These are things that we love to teach and utilize because, like in the volatility in the marketplace last year in August, and then again the beginning of this year, stood with my traders and watched them basically take advantage of what are very, very docile positions, these butterflies, as the market, smashed them down to next to nothing. That meant I could take one side off or the other and expect a boomerang reaction, or during Brexit earlier in June. Those give you a lean. They allow you to have a finite risk position and then adjust it by adding maybe a small amount of risk to it, but having a much bigger upside. So those are some of our favorite positions. And the next question, the explosion position becomes a ratio spread. Now, to be fair, the examples that I gave in the heretofore ancient book, Market Wizards, was financed by gamma scalping around a large position. Now, you can gamma scalp upstairs around a large position by trading in and out of the futures, and based on the gamma of your position. So the explosion position is a ratioed spread, but it's typically where you're buying a lot more calls on the upside or puts on the downside than might make sense, because you're being able to finance them through the delta hedging of a position. Okay. John Netto, most historical vol measures high to low of the range, but not necessarily the price path. Absolutely. I don't know if that's a question, but it's historical volatility is a benchmark that you can use. It's regression to the mean, but it doesn't always happen within the cycle of an options expiration. So the great guessing game is to try to forecast what implied volatility is going to do. You have implied volatility today. It's calculated by the marketplace. Is it going to stay there? Is it going to move lower to historical if it's trading high, or up to historical if it's discounted, or is it going to expand? The VIX kind of gives you an indication, but it's not, I tell my guys it's a barometer more than a thermometer, okay? It gives you an indication, but it isn't an exact temperature. It's only a temperature at that moment. Let's see. Do you have any open trades in options in 10-year U.S. Treasuries? No, I don't trade any. We don't trade any debt instruments. Sorry about that.
I see a question on how far out in time is optimal for initiating a butterfly?
Oh, great question. Well, okay, so the further out you go, the cheaper the butterfly is going to be. It's about time decay in price, right? So to me, an optimal situation is to look about 6 weeks out, and the slightly out of the money call butterfly or slightly out of the money put butterfly is probably going to be cheaper than the at the money, and it's really about where you feel the underlying is going to travel to. So a perfect scenario is you have done a combination of fundamental and technical analysis, and you believe that there's a report date or an earnings date, and you believe the underlying is going to move reasonably to a place that is away from the current market right now, and go out to that date and see that butterfly structure around that target price. But sometimes the near term just gets smashed because of an explosion in fear, and the implied volatility ramps up. And I look at options as like little clouds that are crushed until vol explodes them up, and they're all going to puff up equally. And the more the vol increases, the strikes start to touch each other in relation to butterflies. So the clouds become equal size, and next thing you know, the 21, 22, 23 butterflies trading next to nothing, because nobody puts any value on the 21, 22 vertical, or no more value on the 21, 22 vertical than they do on the 22, 23 vertical, and you can snag those butterflies cheaply, okay? During the crash of 87, OEX implied volatility was over 200. Puts were going up as the index was rallying, and you could throw all calculators and all theoretical value indicators or calculators out the window. So when that happens, butterflies could actually become inverted, which is crazy. You want to buy all that you can for free, but you can also leg into them. So if you have a running start on a direction and you have some profit in a call, for instance, then you sell the ratio spread on top of it. You can leg into a butterfly for nothing or for very cheap or even a credit, and you just set it and forget it, and you let it be. And at that point, you put it, what we would say, put it in the spread hopper, and it becomes a little asset that you cross your fingers. The underlying is close to at expiration. It could rain a lot of money on you, or you look at it and say, well, for the amount of time I've held it, I've made a reasonable amount of money on it. Let's endeavor to take it off or hedge it.
Do you have any favorite commodities at this time?
Any favorite commodities? Well, to be frank with you guys, I've been really focused on the soybean complex in China, and that looks to be, an up-and-coming marketplace that is going to lead to a lot of exciting trade, both here as they bring some of their trade here to hedge, and vice versa. So, I'm not trading beans myself, but I have been in and around a lot of bean traders over the last 6 or 9 months, and it looks to be where a lot of the action is. So our focus is predominantly on U.S. stocks, listed options on U.S. stocks and indexes. So my guys trade SPY and SPX and the more active big name stocks. So I know that's not exactly this audience, but maybe some of them are curious about it. I think beans are, probably going to become additionally active fourth quarter or first quarter when the Chinese launch their options product. I see one here, Tom, that says, how do you offer control risk on sold uncovered options? Hedge delta, close position after the premium doubled, or anything else? Okay, so if you're short uncovered options, okay, now you're talking about the ultimate in risk, and you have to have the most margin money up for those contracts, those kind of positions. If you're talking about short calls, you have theoretically unlimited risk on the upside, but commodities don't go to the moon. And if you're short puts, you have a defined amount of risk, but it could be severe depending on how close to the money your puts are. So the risk control of a naked options position is typically, you're calculating your risk and typically selling other options against it. So that's another strategy, a strangle or a straddle, that has trading characteristics, and depending upon implied volatility conditions, for instance, in super high implied volatility environments, that's a good strategy to employ if you're well capitalized. But there isn't any, you have reverse gamma scalping on that, so you're basically selling underlying on a delta hedge. As you said, you hedge with delta. If you're short and at the money, it's typically a 50 delta, so for every 2 calls you're short, you're going to buy 1 underlying, or every 2 puts you're short, you're going to buy or you sell 1 underlying, or for every 2 puts you're short, you'll sell 2 calls, so on and so forth. You close a position, you're asking, is it a rule of thumb to close the position after the premium has doubled? Well, I've never been a real solid student of premium selling, but I will say I was, hyperactive in money management, and what I mean by that is depending upon how much capital you have, a doubling of a premium may be a good time to double your position. If you started with selling 1 and the premium went against you by double, but you have plenty of capital and you think this is outrageous, maybe selling 2 at that point is going to be the best money management strategy for you. these are all very highly personalized decisions you make based on your capital. We go over that in the book about how, you know, you have to sleep at night and you have to not trade out of fear. Having said that, everybody should expect to lose money in options on occasion, and then you learn by losing a small amount quickly and realizing that that's your threshold, and you need to change course and change your strategy a bit. But short options is the toughest thing. All right, so how do I form an outlook for my trade? Well, I think I talked a little bit about that in terms of the butterfly. You know, typically, my guys are using technical analysis to a great degree. They are doing swing trading to some degree, but they're also, you know, very good at looking at relative pricing and when strategies get cheap or expensive. Note that I said strategies, not necessarily naked options that just might look overpriced or undervalued, because it's really important to look at the options in relation to a nearby other option. Okay, so we look at or they will form their outlook for their trade with a 4, 6, 8 week time frame, and then look to see what the board looks like, and then trade typically gets them into opportunities, and they have their daily, weekly, monthly, quarterly targets of how much they want to make. It's all a lot of fun, actually. It could be a lot of fun. I think here's one from Grant. What is your opinion of trading the weekly E-minis? Well, yes, we use the weekly E-minis liberally, depending upon our need and our position. Now, if that's just your strategy to form spreads and strategies around the weekly E-mini, I think it's a great idea. There's a lot of liquidity there, and they're very popular. So that's actually a great contract to trade, and it's very active. So it's going to become more and more active. I like that, Grant. How far out in time is optimal for initiating a butterfly? Well, if you go out and do long-dated options, then that butterfly is not going to breathe very much, meaning the price is not going to change very much over the next few months. Let's say you go out a year or more, depending on what's on the board. I know, in terms of SEC options, you can go out a couple years. Having said that, if you get the butterfly very cheap, you just forget about it, right? It's not going to cost you anything. It's minimal margin to carry it, and it really is what's available. If you're looking to initiate a butterfly to trade around, then I'm definitely staying inside of 9 months. But like I said, preferably the second or third expiration out from the front. The first one's going to move very, they're going to be hypersensitive. So if you can buy a front month really cheaply, fine. Or if you could sell it on an expensive expensive point of view, a $1 butterfly. If you can sell a $1 butterfly for 80, 85, 90 cents, then you've got a pretty good risk reward that if the underlying moves quickly, it's going to collapse. You can take it in, and you don't have to wait till expiration.
Okay, Tony. I don't see any more. Was there?
There's one here. What are your favorite? Somebody already. What are my favorite commodities trade? I think I answered similar to that. Richard asks, will this book take in previous books? So my previous books were designed and written to be trading manuals. where, you know, we really started from a standing stop, very much beginner to intermediate, and they were created to, you know, be at your desk, make notes in them. It gives you quizzes and everything. I think the last one I did was over 10 years ago. So what I did with this one is take it from much more intermediate point of view and talked about relative pricing, some of the history that goes into that, what to watch out for, and there are examples and strategies, what to use, how to use them, but it's more about you know, managing what you think you're going to get out of your options trades, and not to be you know, a basic primer to get started on options. But it does have equations, and, you know, I don't know, Michael, we have like some 220 charts and graphs in there, a lot of examples, and they're kind of a generation apart, really. And there's vignettes from various people I've traded with and encountered me over the years in various different markets around the world. So it's you know, it's a piece that stands on its own to a great degree.
Well, I'm sure our audience is looking very forward to getting it and learning more from you. Again, Tony, we really appreciate your time here and making this presentation. We have a lot of compliments coming in on it, and it's nice and detailed, covering a lot of different strategies. And again, I want to say thank you for your time. As I mentioned at the start of this webinar, as I mentioned at the start, this webinar was recorded, and everybody who's registered will receive a link to the recording via email. Again, thank you, Tony. Thank you, everyone.
Thanks, everyone. Enjoy your weekend. Good trading.